In 2025, the global economy grew at around 3%. The United States, under 3%. The Eurozone, around 1%. China, 5%. Vietnam, 8%. One of the fastest growing large economies on earth. And most Western investors still aren't paying attention. Vietnam's GDP growth isn't a one-year story. Over the past 2 decades, Vietnam has averaged 6 to 7% annual growth through the 2008 global recession, through COVID, where it still posted positive growth when most of the world contracted, and in 2025, it accelerated to 8%, second highest growth rate Vietnam has recorded since 2011. That kind of consistency is rare. The US averages 2 to 3%. Europe, even less. Japan has spent decades fighting to stay above zero. Vietnam doesn't just grow fast in good years. It grows fast in bad years too. So what's driving it? 3 things. First, manufacturing migration. Global supply chains have been shifting out of China for years. Vietnam has absorbed a massive share of that shift. Electronics, textiles, footwear, semiconductors, export-driven growth that keeps compounding. Second, domestic consumption. Remember that median age of 31? A young, urbanizing population spending more every year. Vietnam's consumer market is growing from the inside out. Third, foreign direct investment. Vietnam attracted tens of billions in committed FDI in 2025 alone. That capital is building factories, infrastructure, and jobs, which feeds directly back into growth. 3 engines, running at the same time. That's unusual, and it's why the numbers look the way they do. Here's where it connects to investing. GDP growth doesn't automatically translate into stock market returns. That's a common mistake investors make. But it creates the conditions for corporate earnings growth. More consumption, more lending, more construction, more exports. Companies operating in an 8% growth economy have a very different earnings environment than companies operating in a 1% growth economy. Vietnam's listed companies, the banks, the developers, the exporters, are running inside that engine. That's the backdrop. That's the operating environment. Now, fast growth comes with real risks. Vietnam is still a frontier market. Liquidity can be thin. Regulations can shift. The Vietnamese dong adds currency exposure for foreign investors. And Vietnam's growth is tied to global trade, which means external shocks matter. These aren't reasons to avoid the market. They're reasons to understand it before you enter. Every high-growth market carries higher risk. The question is whether the return potential justifies it. For many investors, it does. 8% GDP growth in 2025, 2 decades of consistency, 3 structural engines still running. Vietnam isn't growing fast by accident. The fundamentals are real, and the stock market sits on top of those fundamentals. In the next video, I'll break down the 49% rule, the foreign ownership cap that every investor needs to understand before they put a single dollar into a Vietnamese stock. Follow the channel so you don't miss it.